All right, what doesn't look delicious is some of the oil prices and gold prices that are going on right now. It's all amid the conflict in Iran. Oil prices have gone up and down. Now, last I checked was $97 right now per a barrel of crude. Here to tell us more about the fluctuating prices and why we should ignore them is Chase Wilsey, the Vice President of Wilsey Asset Management. Good morning. I know that a watched pot never boils. Is that kind of the philosophy here?
I mean, the thing with the oil prices, as we've seen, they're all over the place, and it's really uncertain what's going to happen with the situation in Iran. What are they going to do next? What are we going to do next? I mean, last week we saw oil prices spike, and then we saw them fall back down last Monday, I think, to under 85. Now we're back to $100 a barrel, essentially, on WTI. I think I saw Brent crude hit 108. So it is all over the place. And the thing that I look at is if you look further out on oil futures, they're still around 70 near the end of this year. So what we're looking at is if this situation in Iran becomes resolved, well, you're going to see oil prices fall back down quite quickly. They're not going to go back to where they were essentially at the beginning of the year because it'll take some time to turn the spigots back on. But again, as things kind of start to resolve, and it doesn't mean the Iran-U.S. situation is resolved, but if we can get the Strait of Hormuz figured out a little bit, that's where you'll start to see some of that pressure subside.
We've talked about this before, and I apologize for repeating myself, but at the first sign of trouble, prices tend to go up quickly, very quickly. But yet, at the first sight of success or peace or whatever you want to call it, prices really take their time going back down. They don't go down as quickly as they go up. Why is that?
I'd say the big reason for that is the way the oil market, the energy market works, right? So we'll look at the Strait of Hormuz situation right now. About 20% of all global oil flows through the Strait of Hormuz, which is essentially closed right now. It's not officially closed, but people aren't going through there. And the reason that's important is now you have countries like the UAE, Saudi Arabia, they're having to curtail production because they can't ship that oil or all of that oil out because of the Strait of Hormuz closure. Now what happens is when you shut down those oil rigs, it doesn't come back online immediately. It takes time for them to get back ramping up to full production. So that's why you see oil prices spike faster than you see them come back down.
And is there not a political component to all this, that there are people in this country who are not really, they're loving the fact that the economy is spiraling, because there's a midterm election coming up, and that will become a political issue, and if it isn't already, it will soon, very quickly. And there are elements in our society who don't want to see this problem resolved. Is that a fair statement?
I mean, it could be a fair statement, and unfortunately, I think it is true, and it is going to be likely, I'd say, to start seeing political ads for the midterms that are probably highlighting exactly what you're saying.
And so, and then there's also the element of the oil companies who, they're making some money right now, are they not?
I mean, they're making some money, and the thing that you look at, though, this is, again, in my belief, a short-term situation. I don't foresee this lasting, frankly, 6-12 months. If the Strait of Hormuz were to remain closed for 6 months, we'd have some serious problems. And, you know, kind of speaking politically, I don't think, you know, President Trump is sitting there saying, oh, I want oil to spike to $200 a barrel.
No,
he knows the midterms are around. So I think they're going to start figuring out ways, and that's why I wouldn't bet on oil going to $200 or maybe even $150 a barrel. They're going to have some different levers to pull. I mean, we've already seen it with the Strategic Petroleum Reserve release. That should help oil prices a little bit. The IEA, which is a global entity of about 31, I think 32 member countries, they released about 400 million barrels collectively. The other big factor, too, that we're not talking about is China. China is a huge oil buyer. Last I looked, they had about 1.2 billion barrels of oil in reserves. They don't necessarily need to keep buying oil. They have a little bit of that reserve to kind of maybe curtail the global demand picture. Could the U.S. maybe put some pressure on the talks with China to say, hey, can you help with this price of oil? Nobody wants oil at $150 a barrel. That is where I think, again, you got to be careful betting on oil going to 150, 200. There are different levers that can be pulled.
Chase, we have to call it a conversation. Thank you so much for your time, and we'll talk about this again next week, I'm sure.
Sure.
All right, we're going to get another look